You walk into your bank branch on a Tuesday afternoon, waiting in line like everyone else, holding a number ticket. The teller processes your transaction with practiced efficiency, but zero enthusiasm. Meanwhile, across the lobby, someone gets escorted into a private office with leather chairs and complimentary coffee. You've probably wondered what makes that person different. Spoiler alert, it is not their charming personality. It is their bank account balance, and there are specific numbers that flip a switch in. How financial institutions treat you. Hey everyone, I am Henry. And I've spent years studying how money actually works behind the scenes. I am talking about the systems banks don't advertise on their websites. I share these insights because I believe everyone deserves to understand the game they're playing. If you are interested in learning the real rules of personal finance, don't forget to subscribe and hit that like button. It really helps me reach more people who need this information. Here is what most people don't realize. Banks operate on a tiered service model based on your net worth, and there are 3 critical thresholds where everything changes. I call these the recognition levels, and understanding them gives you a roadmap for your financial journey. These aren't arbitrary numbers. They're based on how profitable you are to the bank and how much attention they're willing to invest in keeping your business. Once you cross each threshold, doors open that you didn't even know existed. Better interest rates, waived fees, dedicated advisors, and access to financial products that can genuinely accelerate your wealth building. Let me break down these 3 levels for you. The first threshold sits around $50,000 in total net worth. This includes everything you own minus what you owe. Your checking account, savings, retirement accounts, minus credit card debt and loans. At this level, you transition from being a cost center to a potential profit source. Banks start seeing you as someone worth keeping around. Sarah, a marketing coordinator making $55,000 a year, hit this mark after 3 years of aggressive saving. She walked into her bank to ask about a personal loan for a used car. Before this threshold, she would have gotten a standard 7% interest rate, with minimal negotiation room. But because her accounts showed consistent savings behavior and she had crossed that $50,000 mark, the loan officer offered her 5.2% and waived the origination fee. That difference saved her over $800 across the loan term. The bank's system flagged her as a retention priority. Another example. My friend Marcus had been banking with the same institution for 6 years. When his net worth hovered around $30,000, he got hit with overdraft fees twice in 1 year, $70 total for mistakes that lasted less than a day. Once he crossed $50,000, he called to dispute a similar fee. The representative not only reversed it immediately, but enrolled him in a free overdraft protection program that wasn't mentioned in any of their standard materials. The system literally unlocked different options for him. The second threshold is where things get really interesting. Around $250,000 in net worth, you enter what banks internally call their mass affluent segment. This is where you stop being just another account number. Jennifer and Tom, a dual-income couple in their late 30s, crossed this line after selling their starter home and rolling the equity into their next purchase while maintaining healthy retirement accounts. Within 2 months, they received a call from a private banking representative they'd never heard from before. This person offered them a relationship review, which sounds boring but turned out to be incredibly valuable. They got access to a portfolio line of credit at 3.5% interest, no annual fee. This became their emergency fund replacement, allowing them to invest the cash they'd been keeping liquid over 5 years. That strategy generated an additional $32,000 in investment returns they would have missed. At this level, banks also start bending rules. Tom needed a mortgage for an investment property. Standard lending would have required 25% down and a higher interest rate for a non-primary residence. Their private banking contact structured it as a portfolio loan, requiring only 15% down at a rate only half a point above their primary mortgage. That difference meant they could enter the real estate investment market years earlier than planned. The rental income from that property now covers its own mortgage plus generates an extra $600 monthly. The third threshold sits around $1 million in net worth. This is when you become what banks call a high net worth individual, and the transformation is dramatic. My colleague David crossed this line at 47. after a combination of diligent saving, company stock appreciation, and real estate equity growth. He didn't announce it, but within 3 weeks, he received invitations from 3 different banks offering private wealth management services. The bank he'd been with for 15 years suddenly assigned him a dedicated wealth advisor, offered him free estate planning consultations worth thousands, and gave him access to investment products with significantly lower fees than retail options. Here is a concrete example of the difference. David wanted to diversify into commercial real estate but didn't want to manage properties. Retail investors typically access this through REITs that charge management fees and trade with market volatility. His wealth advisor connected him to a private commercial real estate fund with a minimum investment of $250,000, offering preferred returns of 7% before profit sharing, with tax advantages that effectively boosted his after-tax return to nearly 9%. This option simply doesn't appear on the menu until you hit this wealth level. The credit access changes too. David got approved for a securities-backed line of credit, with a $2 million limit at 2.8% interest. He doesn't use it regularly, but having that access means he never has to sell investments at a bad time. To cover unexpected expenses. When his daughter's dream college acceptance came with a tuition gap, he used the line temporarily rather than liquidating stocks during a market dip, then paid it back over 6 months. That flexibility saved him approximately $15,000 in avoided capital gains taxes and opportunity cost. Now, I know what some of you are thinking. Henry, I am nowhere near these numbers. I am trying to figure out how to save my first $5,000. Why does this matter to me? Great question. And this is exactly why I am sharing this information. Understanding these thresholds gives you a strategic roadmap. You are not just saving money aimlessly. You are working towards specific levels that unlock tangible benefits. Every dollar you save is moving you closer to better treatment, better rates, and better opportunities. You might also be thinking this sounds like banks are discriminating based on wealth, and that feels unfair. You are not wrong to feel that way. But here is the reality. Banks are businesses optimizing for profit. Someone with $50,000 in deposits generates more fee income and loan interest potential than someone with $5,000. Understanding this isn't about agreeing with it. It is about playing the game with full knowledge of the rules. Once you know the thresholds exist, you can strategically position yourself to benefit. Another concern I hear often is about market volatility affecting net worth. What if you hit $250,000 but then a market downturn drops you to $200,000? Do you lose the benefits? In practice, banks look at average balances over time and relationship history. If you've established yourself at a certain level, short-term fluctuations don't typically trigger a downgrade. They're interested in your trajectory and overall relationship value. Plus, the strategies and knowledge you gain at each level stick with you regardless of temporary balance changes. So what can you actually do? With this information starting today, let me give you specific steps. First, calculate your true net worth right now, not what you think it is. Actually write down every asset and every debt. Use a simple spreadsheet or one of the free apps available. You need a baseline number to track progress against these thresholds. Update this quarterly. Watching the number grow creates motivation that vague feelings about your finances never will. Second, if you are below the first threshold of $50,000, make that your focused goal. Break it down. $50,000 might sound overwhelming, but it is roughly $417 per month over 10 years, or $833 per month over 5 years. If that still feels impossible, start with whatever you can do. The momentum matters more than the initial amount. Automate transfers to a separate savings account the day after your paycheck hits. Even starting with $100 monthly builds the habit and the balance. Third, once you approach any threshold, proactively contact your bank. Don't wait for them to notice you. Call and ask about relationship banking options or wealth management services. Mention your account balances and ask what benefits you qualify for. Many banks won't automatically upgrade your service level. You have to advocate for yourself. Script it out if that helps. Something like, I've been banking with you for several years and my accounts have grown significantly. I'd like to understand what additional services or benefits I might qualify for based on my relationship. Fourth, compare what multiple banks offer at your wealth level. Once you are approaching $50,000 or higher, shop around. Some banks have better private banking programs than others. Credit unions often provide high-touch service at lower thresholds than big banks. Online banks might offer better rates but less personal service. Figure out what matters most to you, then move your money strategically. Banks hate losing deposits and will often match competitor offers to retain you. Fifth, use each threshold as leverage for specific asks. Approaching $50,000. Negotiate fee waivers on checking accounts, credit cards, or safe deposit boxes. Approaching $250,000. Ask about portfolio lines of credit, reduced investment management fees, or access to better mortgage rates. Approaching $1 million. Request dedicated advisor access, estate planning support, or invitations to exclusive investment, OP opportunities. Be specific about what you want. Banks respond better to clear requests than vague inquiries about better treatment. Look, here is the bottom line. The financial system has invisible tiers that dramatically affect your wealth-building capability. Most people never learn about them, so they leave enormous value on the table throughout their lives. Those waived fees add up to thousands over decades. Those better interest rates on loans save tens of thousands. That access to better investment vehicles can mean hundreds of thousands in additional returns over a lifetime. The difference between someone who understands these thresholds and someone who doesn't can easily be $500,000 or more by retirement, starting from the exact same income you don't have. To accept being treated as just another account number, you can strategically build your net worth with these specific targets in mind. Then leverage each level for maximum benefit. This isn't about becoming obsessed with money for its own sake. It is about understanding the game well enough to win it. So money stops being a source of stress and starts being a tool for the life you actually want. If this information helped you see your financial journey differently, do me a favor and hit that like button. Share this with someone who is working hard but feels like they're not getting ahead. They need to know these thresholds exist. Subscribe if you want more content that reveals how money really works behind the marketing and fine print. The path to financial freedom isn't mysterious. It is just information that most people never get access to. Now you have it. The only question is what you'll do with it. Start calculating that net worth today. Pick your next threshold. Make a plan to get there. Your future self will thank you for every step you take right now.